Dear students, we welcome you all again this morning in yet another important session of income from house property. And today we are fortunate to have amongst us CA Kotha Srinivas sir, member of our Central Council and also the Vice Chairman of International Taxation Committee, a very important committee. And then we have the speaker for today, CA Jignesh Kumar Parikh sir. And then we have the moderator, CA Faisal Shaji. CA Kotha Srinivas sir, an altruistic hard worker bestowed with exceptional organizational, networking, and administrative skills. He has made noteworthy contribution in whatever capacity he served the profession of chartered accountancy, be it as a past chairman of SIRC. He has been a prolific speaker at national international forums. And as an orator par excellence, he has attended and contributed to various national and international seminars. So, sir, we welcome you for this very important session of today. Please, can you address our students now, sir?
Yeah, thank you. Thank you, Alok. Good morning, students. Also, good morning to the day speakers, CA Jignesh Kumar P. Parikh and CA Faisal Shah. Today, you have assembled for this Module 2, practical training modules for CA students. It's a very good initiative. I should thank the Chairman and Vice Chairman of SSCB, Board of Studies Operations, CA Sushil Kumar Goyal and CA Palasrita. Today is a session 4. I feel that I have just got the program structure. Today we are talking about income from house property and other sources. Of course, we have the speakers who will take you through the provisions of income from house property and other sources. I will only take few minutes to just tell you briefly about income from house property. In fact, before talking to you regarding the income from house property, we should understand or we should have the framework of sections. I hope most of you are from intermediate course, may not be final students. Most of you may be the intermediate attending students or writing the intermediate examinations. First, we should understand the section, the structure of the sections. Maybe income from, we know 5 heads of income: income from salary, house property, business or profession, capital gains, and other sources. First, we should understand the sections. So, income from salary is 15 to 17. Then we have income from house property, which is from 22 to 27. Then income from business starts from 28 to 44. Then we have capital gains, which starts at 45 to 55, 55A, and then other sources from 56 to 59. So we should have this boundary so that whenever you come across this particular head of income, we know that we are only talking about this section. So if it is income from house property, we know it is between 22 to 27 as such. Coming to income from house property, we have 22 to 27, that is 6 sections. So section 22, 23, 24, 25, 25A, 26 and 27. So section 22 is a charging section. Then section 23 talks about gross annual value. Then section 24 talks about deductions that are available. 25 deductions which are not available, and 25A is there, which is with respect to unrealized rent and arrears of rent received subsequently. Then we have section 26, which talks about co-ownership, and section 27 is a definition section, which defines 2 important things. One is a deemed owner, and the other one is annual value. Of course, I don't want to get into each and every section in detail. Maybe I'll just briefly tell you about income from house property, because we have learned speakers who will be there to share their knowledge, expertise knowledge with you. When we come about income from house property, the general aspects, let me tell you. Income from house property is taxable on accrual basis. It's not on receipt basis. The first thing we have to understand, income from house property is chargeable on accrual basis. If I have to see the computation of income from house property, it will start with gross annual value. Then from there, we have to deduct the municipal taxes of that particular property. From that, you will get, after deducting the municipal taxes, we will get net annual value. From the net annual value, we have got two deductions under section 24, 24A and 24B. 24A is a standard deduction, which is 30% of net annual value, and 24B is interest paid on housing loan, or the loan that has been borrowed for construction or acquisition of a house property. The net result will be income from house property or loss from house property. When we talk about chargeability of house property, one thing we should understand, section 22 says the gross annual value of any property which consists of building and land appurtenant thereto, which is owned by the assessee, is subject to chargeability under the head income from house property. If an assessee is having a property which is used for his own business or profession, then that will not be chargeable to tax under section 22. When we talk about charging income from house property, we will have four types of house properties. One is let out property. Then we have something called self-occupied property. And there is another category that is called as deemed to be self-occupied property. And the last category is deemed to be let out property. We will not have a situation where there is partly let out and partly self-occupied property, because even if a property is let out in the previous year, even for one particular day, it is considered as let out property. So when we talk about let out property, there is a provisions, section 23 subsection 1 talks about how to arrive at the gross annual value for let out property. As I said, the speakers will discuss those things. Then we have the self-occupied property, section 23 subsection 2, subsection A. It will deal with the self-occupied property valuation. Then deemed to be self-occupied property, 23(2)B, it will deal. Then we have section 23(4), which talks about deemed to be let out property. So in case of let out self-occupied property and deemed to be self-occupied property, annual value is always nil. So when I set the computation where you have a gross annual value less municipal taxes, then you will get the net annual value. In case of self-occupied property and deemed to be self-occupied property, since annual value is nil, we cannot claim the deduction of municipal taxes paid. So we cannot get negative NAV, it will always be 0. From that 0, if you take standard deduction of 30%, 30% of 0 will always be 0. So you will not get 24A deductions for self-occupied property and deemed to be self-occupied property. We will have only one deductions in these cases, that is interest paid on housing loan. Okay. So what is the amount availability? It may be 30,000 or 2 lakhs, as the case may be, which will be discussed later. If you see the computation, when I explained, I said gross annual value is considered, or it is on accrual basis, and it is also on deeming provisions, it will be charged to tax. From that, we have to deduct less municipal taxes paid. So what does it mean? Less municipal taxes paid means, so whatever the actual municipal taxes that has been paid in the previous year, that only will be eligible for claiming deduction under the 23 provisions, that is a deduction from gross annual value. It is not on payable basis. In the previous year, if an assessee has paid towards municipal taxes for a particular property, house property, that will be allowed as deductions, whether it pertains to previous year or previous to previous years. Only on actual payment basis, it will be allowed as a deductions. So from gross annual value, so gross annual value you will get only in the case of let out property and deemed to be let out property. So whatever that calculations you do, you will get the gross annual value less municipal taxes actually paid will be deducted, where you will get the net annual value. Then 24A is 30% of net annual value, you will do the deductions. Then interest paid on housing loan. So interest paid on housing loan, it's not only deductible on payment basis, but it is deductible on payable basis. So whatever interest that has to be paid or payable in the previous year, that will be allowed as a deduction under section 24 subsection B. The net result, it will be either income from house property, or if the net annual value is less, the deductions are more, then it will be loss from house property. Then 23 subsection 5 is there, where in case of builders or people who own the properties for as a stock in trade, the property held as stock in trade and which they cannot sell during a particular previous year, then on that stock in trade, you are supposed to treat that as deemed to be let out property, and as per the calculations, we have to compute income from house property on that properties as such. And there is something called assessee may have more than 2 houses, 3 or more houses, where he's either using for his own purpose, or it can be considered as deemed to be self-occupied property. In those cases, at the option of the assessee, he can treat 2 houses as self-occupied and the remaining houses has to be considered as deemed to be let out property, and accordingly, income from house property has to be charged. Then there may be one question whether all the house properties should be any property income, whether it should be charged under the head income from house property or under any other head. So as the charging section says, property consists of building or land subordinate thereto. So any land which is part of the building, that is also considered as a house property. If it is a vacant land, then the income from vacant land will be charged to tax under the head income from other sources. So in the cases where the property is there, and property, maybe they will give the definition of property. It's not just a residential property, it can be even a commercial property. If it is been given on rent, that will be charged to tax under the head income from house property. In majority of the cases, whenever there is a property, the income will be charged to tax under the head income from house property. In few circumstances, it can be like it will be charged to tax under the head income from other sources or income from business or profession as such. Then we were talking about section 25, where it is the interest paid is not deductible. So in certain cases where if you are supposed to pay interest to a non-resident, and if interest is not, means TDS has not been deducted on such payments, then it will not be allowed as a deduction under section 24 subsection B. Then we have something called section 26, which talks about co-ownership property. So co-ownership means if a property is held by more than one person. So if 2 or more people are holding a particular property, it is called as co-ownership property. And if you know the shares of each and every person, if it can be determined, then it will be assessed in their individual capacity. So if, say, suppose there are 4 people who are holding a particular property, all the 4 are having 25% share in that particular property, then individually that whatever the income from house property is there, it will be divided among all the 4 people up to NAV. Up to NAV, whatever comes, first you have to arrive at the NAV, that is net annual value, that will be shared among the owners in their ratios. In this example, what I said is 25%. Then from there, they can calculate 24 deductions independently in their respective income tax returns as such. If the shares are not determinate, like all the 4 are there, we don't know what is the shares of each and every person, then it will be assessed as association of persons. Then we have section 27, where on certain circumstances, it is considered as a deemed owner. So usually in charging section, we say that a person who owns the property, who is the owner of the property, is subject to taxation. But there are certain circumstances where he may not be the owner of the property, but still he will be subject to taxation under the head income from house property. And we know that whatever income earned in the previous year is charged to tax in the assessment year. So an assessee may be a owner in the previous year, but he may not be owner in the assessment year. But still, whatever the income that was earned in the previous year is charged to tax in the assessment year. So he will be charged to tax as a owner of that particular house property as such. Some of the deeming provisions are there where if it is for a part performance, or if there is a transfer of house property from an individual either to his spouse or a minor child, or if there is a transfer on lease, if any property has been given on lease which is more than 12 years. So in all those, or a person who is the owner of an impartible estate, like this, there are certain circumstances where you can have what do you call this, a deemed owner concept, and the deemed owner will be charged to tax. And there may be a situation where there may be 2 owners. One owner may be for the land, the other person may be the owner of the building. So it's not that same person should be owner of both land and building. So that is also there. Then we have certain provisions of set off and carry forward. We have certain exemption provisions. We have certain TDS provisions which are related to income from house property. And there are certain, I think, around 10 types of income from house property, which is exempted under Section 10. Maybe I wish that the speakers who are there, they will take you through all those provisions in detail. Once again, I thank the Board of Studies for giving me this opportunity, which is a good initiative to empower the students and equip them to learn more things on Sundays, and see that they will make up their examinations and they'll come out very colorfully and brightfully out of the examinations. Thank you once again, and all the best for all the students who are listening to this. Kindly attend such programs and acquire more knowledge. Thank you, Alok.
Thank you so much, sir, for such a wonderful introduction for the session for today. We have just touched upon, all the important provisions of this important session, and that too in only such a small time. So thank you so much.
Thank you.
And again, we are so much thankful to you for taking out time on Sunday. We all know those Sundays are holiday, but it is one of the busiest days for all of us. Thank you so much, sir. It is your love and affection for the students.
Thank you.
Now, in the interest of the time, I now request CF Anil Shahji, who is also the co-opted member of the Student Skills Enrichment Board and actively contributing to the activities of the board. He is also presently the Vice Chairperson of Gujarat National Human Rights Organization of India and was immediate past Chairman of Ahmedabad branch. Thank you so much, sir, for being here today. I would request you to kindly give the moderator's remarks and also to introduce the faculty of our today's session. Over to you, sir.
Thank you, Alokji, who is equally working very sincerely and hardly for the upliftment and betterment of the students. Respected President sir and Vice President sir and the whole team of SSCB in absentia, C.S. Srinivas sir, the Central Council member and Vice Chairman of the Committee of International Taxation, the very learned speaker, Jignesh Parikh from Ahmedabad, and the team of SSCB. And dear students, I welcome you all on behalf of SSCB to this particular session. Before I give the moderator's remark, President sir has very sincerely requested all the students fraternity to give comments on the proposed new education scheme which is going right now. So I request you all students who are attending right now and who will be seeing this session later on, that please once go through this particular new proposed scheme and then please give your valuable comments on doscred.ici.org. If possible, we will post that link in our comments also, and it is available on our ICI website also. It's very crucial that we play a pivotal role in formation and giving a crucial comment on this scheme, because this is the scheme for the present student and our proposed students who are going to join this particular profession. So friends, it gives me immense pleasure to welcome you all to this 8th live webinar. Is very important aspect which is generally untouched in many parts, that is on house property. Friends, I'm very happy to see that more than 400 students, including students from abroad, are joining this session right now. So kudos to the efforts of SSCB and to the direction of the persons who are at the helm of the affairs. Friends, whenever you are going to this particular provisions, whenever you are listening to Jignesh Parikh ji, I would sincerely request that your utmost focus should be on what is being taught. Listen to that. Try to have running notes during the sessions. If any doubt comes, don't immediately post it in the comments, because yes, we and the team will be moderating all the doubts, but immediately don't post it. See, first write down that doubt in your diary. If that doubt is not demystified by the speaker in the session, you can write that doubt in the comment box, and at the end, in the last half an hour or so, or at the convenience of the speaker, we will take all those doubts and we will try to ensure that none of the doubts get unsolved or remains unsolved. And also, friends, the beauty of this session is that no tech means not only theoretical perspective, but the topics will be taught to you from the practical perspective. So if you face any practical difficulty in your articleship, in your office, you can post that as a query to us, and we'll be very happy, and the speakers will be very happy to address the same. With these words, now I take a privilege to introduce a very learned speaker from Ahmedabad, CA Jignesh Parikh ji, who is a fellow chartered accountant and practicing in one of the renowned firm, having an experience of more than 11 years in the field of statutory audit of corporate and non-corporate clients, including bank audits. His main area of focus is management consultancy, financial due diligence, representing before income tax authority, appellate tribunal, and many more. And if you ask me how I know Jignesh Parikh ji, then one thing which is very remarkable of him is whenever any new income tax judgment comes, the way within 2 or 3 hours, the whole judgment explained in a very simple language that if I am a practicing chartered accountant and my domain area is not income tax, but still, if I read his WhatsApp message, I can get the crux that what that judgment wants to say. That's how interpretational skill he possesses, and that is what a small introduction by which I can introduce Jignesh Parikh ji. And apart from that, not taking much of the time because his profile goes into 4 or 5 pages, but I can say that he is one of the gem of a person, being a speaker in various seminars, being an author in various books, a regular publisher, and always, you can say, ready to serve our alma mater, may it be students or may it be the members at large. So with these brief words, I take immense pleasure to welcome Jignesh Parikh ji. And yes, Jignesh ji, now the floor is yours. You can address the students. Thank you.
Honorable President and Vice President, sir, Honorable Central Council members present here, Honorable President, Vice President, Board of Studies, Honorable Fanil sir, and all the students present here. At the outset, I convey my sincere thanks for allowing me to present my views on this interesting and important topic, income from house property and income from other source. Whenever I address the students, or whenever I address any, when I address any members, I start my session with a note that, sir, after becoming a CA, we normally get an opportunity to learn in 2 circumstances only. Number 1, when we get an opportunity to deliver a talk, and number 2, when our clients get a so-called notice. So it is always desirable to learn under the first circumstances, so that when there comes a second scenario, we can convert it into vitamin A. So I am really thankful to the Board of Studies for trusting me and allowing me to present my views. Let me also, because I'm interacting with the students, and let me also share upfront, whenever you also get a chance to deliver a talk, grab it with both the hands, because you learn the things like anything. Because one person who gains after delivering a session for sure is the faculty himself, because he has to prepare and because he comes to know about so many things which otherwise remains untouched. Let me acknowledge that I have acknowledged from the dais when I was delivering from the Ahmedabad branch on section 4480 for the first time somewhere in March 2016. I acknowledge, sir, that while preparing for our session, I realized that how many returns I have wrongly filed. Because had I not been given the chance to deliberate on section 4480, probably I would not have been realized about my own mistakes. So that is the precise reason. When you get a chance, grab it with both hands. It will help you like anything. Friends, with this note, now I start with the topic which has been allotted to me. Before I start, as a matter of fact, from income from house property, or when I start with income from other sources, let us first understand the basic idea of the income tax, and then we go to that particular chapter proper or sections proper. Now, total income is defined to mean that total income means income referred to in section 5, computed in the manner laid down in the act. Total income means income referred to in section 5, computed in the manner laid down in the act. Now, if I go to section 6, 7, 8, they talk about the residential, or section 5 precisely, they say that total income referred to in section 5, computed in the manner laid down in the act. So section 5 first. Section 5 says that if you are resident, you are going to be globally taxable. If you are If you are a resident, you will be taxed. That is, you are going to be taxed with respect to income accruing or arising in India, deemed to accrue or arising in India, received in India, or deemed to have been received in India. Meaning thereby you are going to be taxed globally. If you are non-resident, you are going to be taxed with respect to income accruing or arising in India, or income deemed to accrue or arising in India, income received in India, or deemed to be received in India. That's it. You are going to be taxed for that only. If you are resident but not ordinary resident, then what will be the taxability? They are also given in section 5. So the first thing is that I need to know my residential status. Unless I know my residential status, I will not be in a position to identify whether this income is to be brought to the tax or not, or whether this income tax act will be there. I mean, income tax will be there on this particular income or not. So that is the first thing that we need to be clear, that first we need to residential status, and that's why in our act we have first few provisions, first few sections are on residential status. Having understood that, next sections are section 10, 11, and 12, or rather 10 to 13, which talk about income which are exempt from tax. For example, interest on PPF. For example, certain house property income which are covered under section 10. For example, in the past, not today, in the past, dividend income. So all those income, or let's say agricultural income, or let's take an example, profit from the share of profit from a partnership firm. They all are exempt, which are given under section 10. Meaning thereby, let's say I am a resident, I am an ordinary resident, I have a partnership firm in India, I am getting some profit share. So yes, income tax act will be applying on that, but section 10 says that it is going to be an exempt income. So remove that incomes as well. Now whatever incomes are left out, they say that divide it into 5 weights of income. In the past, there were 6 sales. Now we have got only 5 weights. So divide that income into 5 weights, and now our section 15 starts. So section 15, 16, 17 talk about income from salary. Section 18 to 21 now not there. In the past it was talking about interest on securities. Abhi nahi hai. In the past it was there. So that's why I said there are 6 sales. Now this interest on securities got merged with income from other sources. 22, 23, 24, 25, 26, 27, it talks about income from house property. 28 to 44 dB would be on capital gain, profits and gains of business and profession. Section 45 to section 55A, it is going to be your income from capital gain. Section 56 to 59 is going to be once again income from other source. Then after we are going to have certain undisclosed income, that is section 69, 60. Then we have clubbing of income, section 60 to 64. Then after we have the income from undisclosed sources, 68, 69A, 69B, 69C, and 69D. Then we have the topic of set off and carry forward of losses. Then we go for the deductions and we arrive at a final income. So they say that total income means income referred to in section 5, computed in the manner laid down in that, right? So those income which are covered, keeping in mind your residential status, from that income, remove the exempt portion. Whatever left out now, divide it into 5 weights. Then apply the clubbing provisions. Apply the provisions of setup and carry forward. That would give you a gross total income. From that, deduct or remove the deductions. I mean, go for deductions, 80C to 80 or chapter 6A deductions. Whatever is now left out is going to be your total income. Now, our scope for today is income from house property and income from other sources. Let's start with income from house property first. Let us deal with income from house. Let me share the, allow me to share the screen first.
Jignesh bhai, just to interrupt you.
Sure.
Jignesh bhai, we are keeping question answers at last, right?
So it is up to you. I mean, I'm comfortable both the ways. If you want to keep in between, I am fine. If you want to keep at the end, I'm comfortable.
Okay, fine.
I am absolutely comfortable.
Okay,
the only point is there should not be any unresolved doubt at the end of the session.
Yes. Correct.
Sorry, section 22. Now we have a charging section, that is section 22. They say that the annual value of a property. Now we'll go by the each word. They say that annual value of the property consisting of any building or land appurtenant thereto, of which the assessee is the owner. Now, this charging section gives the condition subject to which, if I satisfy those conditions, then only I can enter into this chapter. I'm sorry, sir. Hello?
Yes, sir, you are audible.
So I guess there's something, just give me a minute, I guess.
It's perfectly visible and audible, Jignesh bhai.
Okay, perfect. Actually, yeah.
Students, we are so lucky enough that Jignesh bhai is directly showing us the provisions, like how a practical professional directly searches the things in Keyman, how he solves. So this is the beauty of attending this kind of live sessions.
Apologies for the interruptions. Actually, the page got disappeared. I'm sorry. Yeah, the annual value. What is going to be taxed? They said that the annual value of a property consisting of a building or land appurtenant thereto, of which the assessee is the owner. So meaning thereby, the first thing is there has to be a property consisting of any building or land appurtenant thereto. To enter into the chapter, first condition is there has to be a property consisting of a building, and then is or any land appurtenant thereto, of which the assessor is the owner. So the second condition is that first is there should be a building consisting of any property or land appurtenant thereto. Second condition, of which the assessee has to be the owner, other than such portion of such property as he may occupy for the purpose of any business or profession. Now the third condition that comes out is that this property should not have been used for the purpose of my own business and profession, right? The profits of which are chargeable to tax under the income from, the profits of which are chargeable to income tax shall be chargeable to income tax under their income from house property. Meaning thereby, three conditions are to be satisfied if I want to enter into the chapter. Now understand meaning and understand the importance of a charging section. Unless I fit myself into section 22, then only the 23 to 27 will come to the play. If I do not fit myself into 22, let's take an example, I fit myself into section 28. In that case, 23 to 27 will not come to my rescue. Meaning thereby, if I say that I am getting some rental income from a property which is going to be taxed as a business income, then I cannot take the advantage of the deductions which are available under 24. But if I'm going under 28, then I can take the benefit of section 30 to 37. Or if it is going to be taxed under section 56, income from other source, I can take the benefit under that under section 57. Meaning thereby, I need to first determine whether first I have to determine whether I would be falling under which head, and whether to identify whether I fall into that head or not, I need to identify whether this section is I need to first identify is that whether I am satisfying the conditions of the charging section or not. So the first condition is the annual value of the property. Now once again, let us go to let us ignore the other part. They say that if you satisfy the three conditions, then what shall be chargeable to tax? They say that the annual value shall be chargeable to tax as the income from house property. Just look at those words. If you satisfy the condition, annual value shall be chargeable to tax as income from house property. Now look at the beauty of this section. They don't say whatever rent that you are getting, that is going to be charged. They say that the annual value that is going to be charged. So what is going to be an annual value, which we will see in the coming sections. But we need to understand that what is going to be taxed is annual value, not the rental.
Thank you so much, sir, for joining us today, sir. Sir, he is actually he's there at the airport, so he was trying but unable to connect.
Please, sir, continue.
Okay. So the annual value shall be chargeable to tax under their income from house property. When if we satisfy the three conditions. Now let us get into those conditions one by one. The annual value of a property consisting of any building. Now the question is, what do we mean by building? The word building has not been defined in the Income Tax Act. So the first question that comes is, what do we mean by building? So if I go to now, whenever the section 2 does not give you the definition, or the section 22% does not give you the definition, then the only way left out is I can go to the judicial pronouncements, or I can go to the dictionary meanings. If we go to the dictionary meanings, they said a building is block of bricks covered by a roof. Block of bricks covered by a roof, meaning thereby go down is a building, shop is a building, residential house is a building. So though the name of the chapter is income from house property, do not restrict it to a residential house. It can be a go down, it can be a building, it can be a go down, it can be a basement, it can be your theater, it can be a multiplex, it could be anything. It can be an auditorium, right? So anything which is a block of bricks covered by a roof would be treated as if it is a building. So the annual value, the annual value of a property consisting of any building or land appurtenant thereto, meaning that not only annual value of the building, but also land appurtenant to the building is also going to be covered here. Now the question is, what is land appurtenant thereto? What is land appurtenant to a building? Now land appurtenant to the building is one land which is attached to the building and it is there for the effective enjoyment of the building. Land which is attached to the building and if it is for the effective enjoyment of the building. Now there comes a question. When can I say that this land is for the effective enjoyment of a building? Now, I would say it goes on a fact. It goes on the individual facts of the individual case. Let me give you an example. Let's say I have got a plot of land of, let's say, 5,000 square feet. I have got a plot of land for 5,000 square feet carpet area. For 1,000 square, 1,000 in the middle, I have constructed my residential house, and 4,000 square feet I have kept vacant. All on the four directions, 4,000 square feet house I have kept vacant. But the plot has been kept vacant. Now I say that the first front 1,000 square feet is open. It is my parking area. I park my vehicles there. The left 1,000 square feet is a garden. I do a morning walk over there. I take a morning breakfast there. It is my garden. The back 1,000 square feet area is my swimming pool, and the right side 1,000 square feet area, it is there. I have kept some mini grounds where I do play the things, and I have kept the playgrounds over there. But then, yes, I stay in my house, and this is what this area is for my effective enjoyment. Yes, it would be a land. It would be treated as a land appurtenant to the building. Now wait for a minute. If tomorrow fine morning, department comes and finds that, not only department comes in, but it is brought to the record, it is brought on the notice to the department that I allow the front parking space to use the one of my adjoining garage to park their vehicles. The vehicle which comes for servicing, I allow them to park your vehicles here, pay me a rent. I allow the garden to be used by anybody for having a small garden party. I allow the swimming pool to be used by anybody to carry out the small pool party. Now, mark this thing. In this twisted set of facts, you would find that this land is now has become an independent source of revenue. The moment it becomes an independent source of revenue, it ceases to be appurtenant to the building. And once it ceases to be appurtenant to the building, it will, the rental income derived from that particular land will not be a part of the income from house property. So meaning that if I allow my neighbor that if you want to come and enjoy swimming pool, come and enjoy swimming pool. Have, you come, ek dubi lagao, 10 rupees din. If in a lighter note, then it is an independent source of revenue. It would be my income from other source. It could be BGBP income depending on the facts of the case, but it will certainly not income from house property because now this land has ceases to be the land, that garden, that parking ceases to be independent. So independent, it ceases to be the for the immediate use of the building or though attached to building, but immediately for use of that particular building. We had one similar issue before us in our office where, because now you all are aware that because of the technological developments, the things are easily available. People come before the chartered accountant after reading the provisions. And, so many students are doing the chartered accountancy, so many advices that people are getting now. So a client came to me and said that, okay, came to our office and said that, I want to buy 1 acre of land. I said, okay, good, you buy. Then I would say, I will just construct a small house on that particular land and say that whatever rental income now that comes, that rental income would be my income from house property. I said, sir, no, you can't do this. Reason being, how would you prove, I'm sorry, how would you prove that this particular entire plot, a bigger plot of land is only for the effective enjoyment of that particular smaller house that you have created or constructed? If you fail to do that, the answer would be different. If you say that if you say that I have given this plot as a party plot and whatever income that comes to me, it is my income from house property, I am sorry, this may not be your case. Your planning may fall down to earth. So we need to appreciate that assessee needs to be the owner of a building or land appurtenant thereto, of which assessee has to be the owner. Now going to the second condition, of which the assessee has to be the owner. So if I am the owner of the house, yes, certainly I would be falling into chapter. Now let's take an example. Let's say Fenil sir is owning a building. He is letting out that building to me. I am subletting this building to someone else. Now understand the point. The first and the second conditions are being satisfied by Fenil sir. I am satisfying the condition that yes, the income is coming from a building, but I am not the owner of it. So I am not satisfying the second condition. So I will not be entering in the chapter of income from house property. Fenil sir is going to enter in the chapter of in the chapter of house property, assuming the other conditions are being satisfied. Let us also take an example. The third, let's go to the third condition then. The third condition is that the building should not be used, or any portion of that particular building. Let's say I have got a building which has got 3 stories. Like the first story, the ground floor is being used for my residence. First floor is being used for I have given it on a rent, and let's say the second floor. The second floor is being used for my office. So far as ground floor and the first floor is concerned, yes, I am satisfying the first 2 conditions. But so far as the third floor, second floor is concerned, the second floor is concerned, here it is being used for the purpose of my business or profession. I will not be enter. So far as second floor is concerned, I will not be in a position to enter the chapter of income from house property. It will go to the chapter of PGBP, profits and gains of business and profession. So these are the 3 conditions which are required to be satisfied. Now that leads towards certain questions which are to be addressed first. The question number 1 is that I let out a property and whatever income that comes to me, will that income be an income from house property or it would be an income from PGBP? Now it all depends once again on the facts and circumstances of the case. You cannot come up, or we cannot come up with a standard jacket formula that if this is the situation, then this would happen. We have to look into the facts of the case. The first and the foremost thing, if my intention is to invest my surplus money and get the rental income out of it, yes, it would be my income from house property. But if it is my business to acquire the house properties, maybe my own properties or maybe a rented, if it is rented, then anyway I'm going out of the house property chapter. So let us say that if it is my business to acquire the properties and then to give it on a rent, or let's take an example. Maybe give an example of a multiplex. I construct a multiplex, then I give the property on a rent. If my aim is here, now look at the facts. I have constructed a multiplex wherein there are various shops. I have given that entire different shops to the different people. Okay, it is my income from house property, no problems. But if I also provide other services, for example, the management services over there, housekeeping services over there, maintenance services over there, right? Common area maintenance services, if I provide those different services as well, along with giving the property on a rent, it would be my business income and it will be taxed under the profits and gains of business and profession. Let's take an example. I have bought a house at Manali. I approached Oyo. I asked Oyo that you take this particular house from me on a rent. They take a house from me on a rent. Now, whatever income that comes to me, I am a practicing chartered accountant. I had surplus money. I bought a house at Manali. I gave it on a rent to Oyo. Now, Oyo will pay me the rents regularly. Now, Oyo may give it on a rent to the different people who are going to visit that particular house. Whatever rental income that Oyo gets, it is going to be business income for him. For me, it is going to be income from house property. Correct? So these are the points which are required to be kept in mind. You can also decide whether a particular income would fall in the house property or not. This was the example I have given for an individual. Let's take an example if it is an LLP. Let's take an example as a company. Now, if I look at in case of a company, LLP, you can say from the LLP date. In case of a company, you can go to the memorandum of association. And if the object clause itself of the memorandum of association speaks about that company is incorporated for the purpose of acquiring a property and give it on our end, certainly the income would go to the whatever rental income that comes, that the income would go to the chapter of profits and gains of business and profession. It will not go to the income from house property, and we have a direct judgment of Chennai properties on that. Correct. So we have to take a call accordingly. We have to look into the facts. What are exactly the facts of the case, and accordingly we can conclude whether the income would be falling under that PGBP or not. Now, why this distinction is important? We have discussed in the beginning itself. In the beginning itself, I have discussed with you that if I'm entering into house property, then only 30% wala deduction jo hum aage dekhenge, standard deduction available hai, wo apply hoga. Otherwise, we will not be getting it. Second, if you look at this section 22, you would be realizing, you would be observing कि आपको यहाँ पे depreciation नहीं मिल रहा, कोई खर्चा नहीं मिल रहा है, केवल 30% expense में. लेकिन if you go to the if you go to the PGBP, you will get the depreciation. Let's take an example. I have got a house. Now, let's say this would be a fact, or the client may come to you saying that I have got this particular income. Should I be taking it as a rental income? Should I be taking it as a business income? And assuming the facts of the case are supportive, you can give a kind of a comparison to your client that, look, you will get a rental income. Let's say your rental income is 5 lakhs. From 5 lakh rental income or 10 lakh rental income, you will get 30% deduction. You will get a deduction with respect to the interest. And now this would be the balance amount which is going to be chargeable to us. If you are going for income from house property. Now, if you are going to a chapter, if you are going to PGBP income, you are going to the head PGBP. In that particular case, if you are going to PGBP, what would happen then? In case of PGBP, you will straight away get depreciation. So let's take an example. You have got a property worth 50 lakhs of rupees. The property worth 50 lakhs of rupees normally carry the rental value of 3 lakh to 4 lakh depending upon the location. Now 4 lakh is a property value, 50 lakh is a property, 10% depreciation, 5 lakhs of rupees, straight away your income turned out to be negative. You will get a loss. Apparently you would find, oh, business head is a very good hit. But wait, whenever you are going to sell this building, it would have a short-term capital gain. It would have a short-term capital gain because you are aware that the depreciable asset, gain arising on a transfer of a depreciable asset would always be a short-term capital gain. So there will be a short-term capital gain, and short-term capital gain normally is being taxed at a normal rate. Of course, I am aware that there are certain judgments. Now, Mumbai Tribunal has taken a view that the short-term capital gain, though I am selling a building, which is a depreciable asset, though the gain is going to be a short-term capital gain by virtue of a dimming fiction comes to an end the moment gain is determined. But ultimately, it was a long-term capital asset because I hold a building for more than 2 years, I assume, and then I'm selling it. So whatever gain, it is for computation purposes, it is a short-term capital gain matter ends, but the tax is to be calculated by applying a rate of 20% only. It is a judicial interpretation. I'm not going into it. But right now, if I don't get myself involved into that judicial analysis, as of now, the situation is that I am selling a property, it would be a short-term capital gain. Now, what would happen? Day by day, property price will keep on increasing. And you claim a depreciation, so your cost will go on reducing. So the gain would be on a higher side. So today you may find, okay, it is good, I'll go PGBP. But then at some point of time when you are selling, you would be in a deeper problem. Of course, when I was discussing this with in my office with some of the students, with some of the article assistants, one of my partner came up with a proposition. What would be the situation if I buy another building in the same year? He said, yes, then it will be entering into the block. If you are buying another building, then once again it is going to enter into the block. The block is not going to be nil as on 31st of March. Since the block is not nil, your depreciation would continue. So you have to look into the facts of each case before you conclude that whether you want to go with income from house property or PGBP. Having said this, simply because we find it appropriate to go with house property, and that's why house property is the correct answer, should not be the matter. We'll need to look into the facts and circumstances of each of the case. Depending upon the facts, we have to decide what is going to be the appropriate hit. The example which I gave you, comparison purpose, is just to give you a clarity that which one is a better course of action. Now, you may also be asked by your client that I want to buy a property. Now, should I buy a property in my name and let it out to my company? Or should I buy a property in the name of a company? See, that's where a chartered accountant's role comes into the play. You will enter the figure in a software and the software is going to give you the taxation amount. That would come anyway. I understand that you are in intern or you are in final and you are supposed to know, and a chartered accountant is supposed to know this. But where your and my role will come, the client would come and ask that, should I buy the house in my name and let it out to company, or should I buy the house in the name of the company? What is the way available? What am I supposed to do? Now, if you say that, now look at the situation. Now the example which I gave will come into the play. If you say that, sir, you buy a house in the name of a company and then, or you buy an office in the name of a company, certainly that you will get a depreciation, your tax impact would be reduced. That is going to be a case. And whenever you are going to sell it, there will be a short-term capital gain. But if you are buying this particular building in your own name and giving it to a company, then you would get a rental income. So you will get rent as a deduction. You will get the rent as a deduction. Right? So depreciation is also going to be allowed as deduction. Rent is also going to be allowed as deduction. Every year, depreciation will reduce. Rent would increase. Every year, your income will increase and rent will also increase. So you can appreciate what I'm trying to tell you. It would be an easy way, better way that you buy the property and give it on a rent to a company. Let me make it very easy. Let me make it very simple for you. Number of times, we are aware that if I take a loan from a company, the dim dividend provision will come into the play. I am a director in a company, satisfied, or I am a shareholder in a company having more than 20% shareholding or prescribed amount of shareholding. Will come to that little later, and I'm getting a loan. It is going to be taxable to me as dim dividend. But if I'm getting a rent from a property, it will not be taxable rent. Then there will not be a dim dividend. It would be there, allowed as a deduction to the company, and to me it is going to be taxable. To me it is going to be a taxable, right? I can think of creating a trust. See, why do I share this thing? This only section leads me towards all these possibilities, and this is where we need to explore. We as a chartered accountant need to go and we need to explore the situation and where we need to advise the client. We can say this: create a trust, create a family trust. Create a kind of a family trust. Have the property in that name. Let the trust to you, and you can take the advantage of basic exemption limit, assuming that it is for the purpose of assuming you are satisfying certain conditions given under 164 and the 116, 164. So my point here is, these are the ways in which you can guide your clients. Do not only restrict that, okay, rental income aa gaya, ye karna. These are the ways you can do it. This is the way you can advise your client. You can manage your tax structures. So we are done on section 22. What does it say? If you satisfy the condition, what is going to be taxed is annual value is going to be taxed. Not the rent income, annual value. Acha, yahan par dekho, annual value of house property. If I stay in my house, I'm staying in my own house. One house, I'm delivering a lecture from my house. I'm staying in my house. They say that annual value of this property is going to be taxed. So from section 22 is not exempting anything. Exemption and the things would come later on. 23 may I go. But as of now, section 22 says that even this is going to be taxed to me. I hope section 22 is clear. If you have a query on 22, you may raise. I'll start otherwise with section 23. So now, assuming that I am satisfying the conditions laid down under section 22, now I am going ahead with section 23. Now, they say that for the purpose of section 22, now look at this language. For the purpose of section 22, the annual value of the property shall be deemed to be. For the purpose of section 22, what does section 22 says that? Annual value shall be chargeable to tax as income from house property. Now, that annual value, which is referred in section 22, how that is to be computed? Now, section 23 talks about that. For the purpose of section 22, the annual value of the property shall be deemed to be. They don't say the annual value shall be. They say deemed to be. meaning thereby a dimming fiction has been created. A dimming fiction is being created, shall be deemed to be what? A. Section 23, subsection 1, clause A. The sum for which the property reasonably be expected to late from year to year. That is what you can say your fair rentals or expected rent. You can say fair rental, reasonable rent, expected rent, whatever. The sum for which the property might reasonably be expected to late from year to year. One. Number two, where the property or any part of the property is let, the actual rent received or receivable by the owner in respect thereof in excess of the sum referred to in clause A, the amount so received or receivable. Now they say that, the another option is, another point that they are talking about is the actual rent received or receivable, meaning thereby fair rentals or actual rent received or receivable, whichever is higher, that is going to be taxed. I am aware that all your reference books talk about municipal valuation, the municipal value, and all your books talks about that standard rent. I come to that, but now understand this. The act so far talk about. I would always advise read bare act. Of course, when you are a student, your goal is to clear the examination. You may read your reference book. You may read the commentaries. No problems with that. Once you become a chartered accountant, read the act. So you would come to know that how these conclusions have been derived, right? Because the commentaries, the reference books, they would give you the conclusions, and the conclusion would come from act and judicial interpretations. Anyways, right now, clause A talk about the rent for which the property is reasonably be let, and two, when the property or any part of the property is let, the actual rent received or receivable. If that is in excess of clause A, then take their value. Meaning thereby, fair rental or actual rent, whichever is higher, that is to be taken. Okay, I'll go ahead. Clause number C, where the property or a part of the property is let and was vacant during the. Now, your vacancy allowance wala portion is covered under clause C. So right now, for a time being, I am not touching upon this vacancy allowance wala part. For a time being, I am not touching. As of now, my answer is, what is an annual value? Fair rental value, or where the property or a part of the property be let is part of the property is let and the actual rent received or receivable by the owner in respect of that property's excess. So higher of actual rent and fair rent, that is what is my answer. Okay, wait, the section is not over yet. I am now into the provided. Provided that the taxes levied by local authority in respect of the property shall be deducted in respect of the previous year in which the liability to pay the tax was incurred by the owner according to the method of accounting regularly employed by him in determining the annual value of the property that previous year in which taxes are actually paid by. They only talk about allowability of municipal taxes. So far, so good. Now, for the purpose of this clause B and clause C of this section, the amount of actual rent received or receivable, amount of actual rents received or for the purpose of this clause B or clause C of this section, the amount of actual rent received or receivable by the owner shall not include, subject to the rules as may be made in this behalf, the amount of rent which the owner cannot realize. So up till now, my answer here is fair rental value or actual rent received or receivable, whichever is higher. Now, please mark a point here. Please mark a point here. We have one judgment available which says that your fair rent. Now, what is going to be your fair rent? Your fair rental is going to be the expected rent which you reasonably let out, or your municipal rent, whichever is higher. And now thereafter we have one judgment which says that this fair rentals cannot be more than the rent as determined by rent control. So that is the reason your formula now is fair rental value or rent based on the municipal valuations, whichever is higher, step 1 and standard rent, whichever is less, because by virtue of the judgment. And now the step 2 and actual rent received or receivable. Now look at the irony. The explanation here says that for the purpose of clause B and clause C, the subsection, the actual rent received or receivable by the owner shall not include, subject to the rules as may be made in this behalf, the amount of rent which the owner cannot realize. Unrealized rent will not be there. Now look at the situation. My fair rental value is 1 lakh. The rental value as per the municipal valuation that turned out to be 1,20,000 rupees. You will say whichever is higher, that is 120. Standard rent is, let's say, 80. So it's a 120 and 80. It is going to be 80. Now my actual rent is 8,000 per month. So 80 into 12, 96. So 8 into 12, 96. So 80 or 96, whichever is higher. So 96 is going to be your answer. Now wait for a minute. Wait for a minute. They say this explanation says that for the purpose of clause B and clause C of this section, the amount of actual rent received or receivable by the owner shall not include, subject to the rules as may be made in this, we have the amount of rent which the owner cannot realize. Meaning thereby I gave a property on rent to someone else, and the gentleman did not pay me the rent for 1 month. So now my comparison is 80 versus 96. So my answer is 80 versus 9. My question here is 80 versus 96 is the comparison, or 80 versus 88 is the comparison. If I look at the language, they say that the actual rent received or receivable shall not include. Mind it, that shall not include the amount of rent which I could not realize. So the comparison should be 80 versus 88. Right? Let me make this example a little more complicated. Let's say I didn't get the rent for 3 months. I did not get the rent for 3 months. So 96 minus 24, meaning thereby 72 is going to be my answer. Now my comparison should be 80 versus 96. And that's why the answer is 96. That's why my answer is 96. And from 96, I need to reduce 24. Or I need to say that my comparison should be 80 versus 72. And my answer is now 80 and my taxable value is 80. I hope you are getting the point which I'm trying to share with you. If you look at the bare language, they say that actual rent received or receivable shall not include the amount of unrealized rent. That is 96 minus 24. It means that 72. Meaning thereby my actual rent received or receivable is 72. My fair rental is 80. So 80 versus 72, whichever is higher is 80. My answer to the question is 8 and not 72. Now, if I look at the ITR form, which they only have given, I hope my ITR form is visible to you. So I guess this form is visible.
Yes, sir.
They say that amount of rent which cannot be realized. So now they say that the gross rent received or receivable or lettable value. Now look at this language. Clause A, gross rent received or receivable or lettable value. Meaning thereby, I need to take here 80 versus 96. From there, they say that the amount of rent which cannot be realized, taxes paid, and there the D is going to be my total, that is B and C, and that annual value. That's how I come here with the answer. Now look at this presentation. They in the form say that, in this form, they say that compare 80 and 96, take whichever is higher, 96. From 96, reduce 24. So then you will come down to 72 is the answer. Now the question that really comes is, who is correct? Language or form? Language of the act or the form? That's where the precise question comes. To my mind, if I strictly interpret the provisions, then the law is clear. If I strictly interpret the provision, then the law is clear. I need to compare 80. As I mentioned that, the 90 is of higher rental value, 1 lakh is the municipal valuation, rent as per the municipal valuation, 90, 1 lakh, whichever is higher, 1 lakh standard rent, 80, let's say standard rent is 80, 1 lakh 80,000, whichever is less, so 80. Now 80 is going to be compared with my actual rent received or receivable 96. But by virtue of the provision, I need to reduce 24. So now that turns out to be 72. So 80 and 72, whichever is higher, answer is 80. If I look at the language, the answer is 80. But if I look at the form, they say that you find out annual value first, which is 80 or 96. 96. From that, reduce unrealized rent. What is that? 24. What is your answer? 72. Now mark these things carefully. In case of a clash between form and the act, in case of a clash between rules and the act, what shall prevail is only going to be the act. However, this being the case, if somebody wants to take a view that though strictly speaking, the answer is 80 in this case, but I want to, take that 80 or 96 and then from 96 I'll reduce 24 and then the answer turned out to be 72, then nothing wrong in that. You can always say that your answer is 72. Because you are strictly following what has been given in your form. You are following the presentation given in the form, and the form is always prescribed by CBDT. So certainly one can do that. However, academically speaking, and my view is that one should go with 80 versus 96. Having said this, I do acknowledge that the experts have also taken a contrary view, relying on the format of the form, that when the form itself prescribes this as deduction, I would compare 80 versus 96, keeping 96, and from 96 I'll reduce 24, and my answer is going to be 72. So both this view are as of now possible. Now you can, if you read section 23 subsection 1, you would realize and you would come across you would conclude that कि बॉस यहाँ पर तो हर एक रेंट टैक्सेबल है. इवन मैं जिस घर में रह रहा हूँ खुद के लिए है, अगर वो एक्चुअल रेंट रिसीव्ड और रिसीवेबल इज नहीं है वहां पर, लेकिन उसका फेयर रेंटल वैल्यू 12,000 है, तो अगर 1,44,000 रुपए is going to be tax liability to offer this amount to tax. Yes, if I refer section 23 subsection 1, then this is going to be a situation. But wait, now section 23 subsection 2 comes to my rescue. They say that when the property consists of a house or a part of a house, where the property consists of a house or a part of a house, which is in the occupation of the owner for the purpose of his own residence, or which cannot be actually occupied by the owner by reason of the fact that owing to his employment, business or profession carried on at any other place, he has to reside at that other place in a building not belonging to him. So basically, now look at this situation. So far as if I am staying in my own property, if the house is being used for me for my own residence, in that case, the annual value is going to be nil. Then my annual value is going to be nil. So just give me a second. I'll just use the washroom and come back. Just give me a second. I'll come back use a washroom and come back. I'm extremely sorry for the inconvenience. Yeah. So they say that when the property consists of a house or a part of a house which is in the occupation of the owner for the purpose of his own residence, if it is in my own occupation, if it is the occupation of the owner for the purpose of his own residence, अगर मैं ये खुद उसमें रह रहा हूँ, if I'm residing in that particular property, yes, the annual value is going to be. And second situation, that I cannot actually occupy it because my employment, business or profession carried on by me at any other place. I have to reside in that other place, but in a building not belonging to me. If I'm residing there in a building which is belonging to me, once again, I will not be occupying this benefit. Then the annual value cannot be considered as nil. But otherwise, yes, the annual value is going to be nil if in any of this particular situation. So now you can come and say that, yes, I have a house. I am staying in my house. Yes, the annual value is going to be nil. 23(1) तो कह रहा है कि you have to count the annual value, but the 23 subsection 2 says that the annual value is going to be nil. I have a house in Ahmedabad, but then my profession is at Bombay, or I'm being transferred to Bombay, or my job is at Bombay. I have to stay Bombay in a rented house. My Ahmedabad house is not being occupied by me for the purpose of my business or profession. Yes, the annual value for that particular Ahmedabad house is going to be, even though I'm not occupying it for my own residence, because my inability to occupy is on account of my employment or business or profession, and there I have to reside in a rented house. So that is the situation. The annual value is going to be nil. Now coming to section 23 subsection 3. I am aware that I have not yet dealt with the vacancy allowance part. I'll come in a little while. Let me finish with 3, 4 and 5. Then I'll come with the vacancy allowance wala part. Section 23 subsection 3. The provisions of section 23 subsection 2 shall not apply if. Now they say that subsection 2. Subsection 1 ka exception is subsection 2. Subsection 2 ka exception is subsection 3. So 1 and 3 would come, right? The 2 will not come into the play where the house or a part of the house is actually late during the whole or a part of the previous year. Now look at this. They say that, now if you look at subsection 2 clause A, if the house is in the occupation of the owner for the purpose is own residence. Now you look at subsection 3 clause A, the house or a part of the house is actually let for whole or part of the previous. What does that mean? It means that if I want to club both together, if I want to now say that I am staying in a house, particular house, then I need to be in this house for the whole year. If for a 1 day or a 2 days, I have let out that house to someone else, I will not be in a position to get the advantage of section 23 subsection 2. Similarly, if I say that I am staying in a rented house at Bombay, I'm staying at a rented house at Bombay, and that's why I couldn't occupy my Ahmedabad house. But I have given Ahmedabad house on a rent for a whole or a part of the year. In that case, I'm sorry, I will not be in a position to take the benefit of section 23 subsection 2. So that is how you need to read. Second exception is any other benefit therefrom is derived by the owner. Meaning thereby, if you, now they say that if you are derived, meaning thereby, now you look at the substance of this section. Subsection 1 says that you have to compute the annual value. Subsection 2 says that, okay, you are staying in your house, or you are unable to stay in your house on account of your transfer, on account of your job or a business, maybe not to be transferred, let's say on account of your job or a business, and you are staying in a rented out somewhere else, then okay, we'll say annual value to be nil. Subsection 3 says that wait. The annual value of the 2 will not be nil, or the subsection 2 will not come into the play if the house is let out for any 1 day as well, or you are deriving some any other kind of a benefit. Only one benefit if you can derive for which we will not tax you, that you are staying in your own house. If that is the only thing, we'll say that the answer is going to be nil. Otherwise, yes, it would be taxable. Coming to subsection 4. Where the property referred to in subsection 2 consists of more than, now the word here is 2 houses. Now here the dimmed let out concept comes into the play. Now where the property referred to in subsection 2 consists of more than 2 houses, the provisions of this subsection shall apply only in respect of the provisions of this subsection shall apply. That subsection shall apply only in respect of 2 of such houses, which the assessee may at his option specify in this BR. Now what does section 23 subsection 5 says? 4 says. 23 subsection 1, compute the annual value, nothing doing. Subsection 2, if you are staying in your house, annual value is nil. If you are unable to stay in your house because of your job, because of your profession at some other place, and you are staying in rented premises there, no problems. Annual value is nil. Subsection 3 says that wait. You are not staying in your house, but you are given a house on a rent. You are not staying in your house, but you are given you're getting some other benefit. In that case, we will not give you that benefit. And subsection 4 says that. If you have got more than two houses, to which you want to apply subsection 2. Let's take an example. I have got a house at Ahmedabad and I have got a house at Baroda. Or let's say I have got a house I have got one house at Ahmedabad, Gujarat. I have got one house Bombay, Maharashtra. I have got two houses. They said for this two houses, annual value shall be. I can say that I am occupying both houses for my residence. Then my annual value for that house is going to be nil because I am occupying both the houses for my residence. Now, if I say that I have got one house at Ahmedabad, I have got one house at Bombay, I have got one house at Delhi. They say that for two houses only, you will get the benefit of section 23 subsection 2. Meaning thereby the annual value shall be nil for two houses only, section 23 subsection 2. So advantage given under section 23 subsection 2 is that if assessees, if the house which is in the occupation of the owner for the purpose of his business or profession, if the house is in the occupation of the owner for the purpose of his own residence. Here they say that the house is the occupation of the owner. अब मेरे पास एक घर है, दो घर है, पांच है, because you know that the singular includes plural, plural includes singular. So though the word is when the house or a part of the house which in the occupation of the owner for the purpose of his own residence, I am occupying more than 5 houses and all 5 houses are being used for my residence, then also the annual value is nil as per section 23 subsection 2. Wait, 5 says that the benefit of subsection 2 would be available only for 2 houses. For the rest 3 houses, the benefit will not be available. Meaning thereby for the 3 houses, go and calculate the value as per subsection 1. So that's why you came up with the concept that you have got self-occupied house, you have got 2 self-occupied houses, up to 2 houses, your annual value is going to be nil. More than 2 self-occupied houses, in that particular case, you can choose any 2 houses where the annual value is going to be nil. For the other, you have to compute the value as per subsection 1. That is what you need to understand. Now coming to this. The clause number subsection 4, clause B. The annual value of the house or houses other than the house or houses in respect of which the assessee has exercised an option under clause A shall be determined under subsection 1 as if the house or houses has been let. That is quite obvious. They say that कि आपके पास 5 घर है, you have got 5 houses, which is being. Now let us conclude it in a different way. I have got 5 houses. Out of 5 houses, I have let out 4 houses. Or let us say I have 5 houses. I have let out all 5 houses. I have given all 5 houses on the rent. I am also saying in a rented house. Possibility. There is no law which says that if I have my own house, I cannot stay in the rented house. I find it appropriate that I have got 5 houses. I will let out my house. I have let out my 5 houses. It is possible. Somebody is staying in Borivali and he is doing job at some different other place. Let's say in Navi Mumbai. He may say that I'm doing a job in Navi Mumbai. I'll be in a rented house at Navi Mumbai. My Borivali house is let out. My Andheri house is let out. Right? My Delhi house is let out. My Kolkata house is let out. He can do that. Not a problem. So you have 5 houses. All your 5 houses are let out. There is no question of section 23 subsection 2 because you have no house which is in your occupation. When subsection 2 is not coming into play, obviously 3 will not come into the play. When the 3 will not come into the play, the restriction of 2 houses given in 2, that will also not come into the play. So for all 5 houses, you have to compute the value as per subsection 1. I hope that makes sense to you. I hope that makes sense, complete sense. Out of 5 houses, let's say I'm staying in my one house and 4 houses are given on rent. Obviously, for one house, which is in your own occupation throughout the year for your residence, certainly the annual value is going to be nil. Section 23, subsection 2. For the rest 4 houses, go with subsection 1. If you say that out of 5 houses, 1 house is given on a rent, or let's say 2 houses are given on a rent. Let's say that my Borivali and Andheri house are given on rent. My Marine Drive house, Delhi house, and Kolkata house are vacant. Or let's say I am claiming these 3 houses to be used for my self-occupancy. Now here you can appreciate that in my 3 houses, I can now this benefit is available. Their benefit is available for any 2 houses. Out of these 3, benefit is available for any 2 houses, which I may decide. It is up to me, which I may decide. And for the one house for which I am going to treat it as a deemed let out, the value is to be determined based on subsection 1. So this is what subsection 4 talked about. Now, Coming to subsection 5. Let me finish with subsection 5 first. Thereafter, I will take you to that vacancy allowance portion, and then we'll go to the interest part, and thereafter we'll switch over to the income from other sources. But before that, let's finish with subsection 5 first. Where the property consisting of any building or a land appurtenant thereto is held as stock in trade, and the property or any part of the property is not laid during the whole or any part of the previous year, the annual value of the such property or part thereof for the period up to 2 years from the end of the financial year in which certificate of completion of the property is obtained from the competent authority shall be taken to be the due. What does this subsection provide? They say that, let's say I am a builder and I have constructed houses. I am a builder. I have constructed 10 flats, let's say a 10-floor flat. Each floor is having 2 houses, 20 flats. I have sold 15, 5 are in my possession because 5 are unsold. Here, if the 5 houses are unsold, what is going to be a situation? Can I say that more than 2, so this 3 is going to be taxed to me as deemed let out? We have different contradicting judgments available. Gujarat High Court says no, it is going to be a PGBP income, so section 22 cannot be brought into the play. Delhi High Court says that the PGBP, it will be income from house property, and that it is going to be taxed as income from house property, so the deemed let out provision would be applicable. It is going to be one of the genuine circumstances, and that is the precise reason that Act came up with this amendment. And they said that when the property consisting of any building or a land appurtenant thereto which is held as stock in trade, any property or any part of the property which is not let during the whole or a part of the previous year, the annual value shall be nil up to 2 years from the end of the previous year in which the certificate of the competent authority is obtained, meaning thereby the BU certificate is obtained. So if I'm obtaining BU certificate today, then 2 years from 31st March 22, 31st March 23, so that is, we can say that up to 31st March 25, for those 2 years, the annual value will be nil. If I can sell out, it is okay. If I can't sell for those 2 years, then from the next, that is the 3rd year, it is going to be treated as deemed the let out property. So kind of a relaxation has been given to a particular builder. Now, please mark this important. Here, I need to be having or disclosing this house as my stock in trade. Please understand that if I am buying, I'm owning a plot of land on which I'm constructing a building or flats and then I'm selling, that would be okay. But if I am being appointed by someone else, let's say I'm being appointed by Fanil sir, that he says that I'm owning a plot of land. Jignesh, please come and construct 10 floors. Each floor would be having a 2 flats and give it back to me. Here I am a contractor. Here I am supposed to simply construct 10 flats, give it to him, apply ICDS 3 or accounting standard 7, construction contract, matter ends. That is what I am supposed to do here. Here I will be falling in ICDS 3 or your accounting standard 7. But I am owning a plot of land, or let's take an example, the things are different. I am entering into a joint development agreement with Fanil sir. Fanil sir is owning a plot of land. I am constructing a building on it. I am constructing a 10 flats on it. 10 floor flats on it, 20 flats total. And in consideration, I am supposed to provide him 5 flats and certain money, and 15 flats are mine. So 5 flats which I am supposed to provide him, I have already sold. Remaining 15 flats, I could sell 12 flats. 3 flats are now left out. Now they are my stock in trade. If I can sell that up to 2 years from the end of the year in which I am getting the BU, then it's okay. If I can't, then from the 3rd year, it will be treated as if it is my deemed letter. Of course, I assume that I am having one other house where I'm staying. So now total 2 unsold flats here and one my personal house, so 3 houses. my total 3 houses, any 2 houses I can pick and choose as my self-occupied. One, it is going to be taxed as my, one can be said it is going to be taxed here as my deemed let out property. So with this, I'm done with section 23, subsection 5. Now coming to this vacancy allowance portion. So before I go on to that, if you have any question on section 20 to 23, please raise those questions. Otherwise, I'll start with the vacancy allowance part and we'll put an end to section 23. All right, sir. So I'm going ahead with 23, subsection 1, clause C, which was left out. They say that where the property or any part of the property is let and was vacant during the whole or a part of the previous year. Now look at these words. When the property or a part of the property is let, meaning thereby what they presupposes is that the property has to be let first. Each and every word of the act has to be paid due respect. When the property or any part of the property is let and was vacant during the whole or a part of the previous year. So this presupposes that the property should have been let and then it was vacant. Might be vacant for initial period and then it was let. That is also, but the letting has to be there. When the property or a part of the property is let and was vacant during the whole or part of the previous year, and owing to such vacancy, because of that vacancy, the actual rent received or receivable by the owner in respect thereof is less than the sum referred to in clause A, the amount so received or receivable. Now, what do they say? Let us once again read it. They say that where the property or a part of the property is let and was vacant during the whole or a part of the previous year, meaning thereby they talk about some vacancy allowances. If the property was vacant, it was let and it was vacant, meaning thereby, let's say there was a property 12 months, it was let for 7 months and it was vacant for 5 months. Now, and owing to such vacancy, because of this vacancy, the actual rent received or receivable by the owner in respect thereof, on account of that vacancy, actual rent received or receivable by the owner in respect thereof is less than sum referred to in clause A. If that is the case, the amount received or receivable. What do they mean? They say that, see, general rule is actual rent received, or let's take an example. The clause A is your fair rental value or the municipal value, whichever is higher, that is your clause A. Municipal value and standard rent, whichever is less, this is by virtue of a judgment. Standard rent and actual rent received or receivable, whichever is higher. I mean, let's say standard rent is less. So standard rent and actual rent received or receivable, whichever is higher. This is what is the conclusion till now. Let's put it in the form of an example. My house has got 1 lakh as a fair rental value. Let's say nothing is for municipal value. For timing, let's say 1 lakh is a fair rental value. 1,20,000 is a fair rental value, let's say. 96,000 is a standard rent. So we'll say the standard rent is 96,000. Now my actual rent for the property is, let us take an example, is 9,000 rupees. Now 9,000 rupees is my actual rent. So 9,000 into 12 is going to be 1,08,000. So 96,000 and 1,08,000, the answer is 1,08,000. If my house is let out for the whole year. But if my house has remained vacant, now because of that vacancy, my actual rent received or receivable is less. My house is let out for now only 7 months. 9,000 into 7, it is 63,000 rupees. Now 63,000 is less than 96,000. Now this gap, precisely this gap, is it attributable to a vacancy? That is what the precise question is. Now that needs to be found out. Now how can I find it out? They say that if this gap is on account of vacancy, then 63,000 is going to be your answer. If not, then 96,000 is the answer. Now how can I find it out that? I let out the house for how many months? 7. My house is vacant for how many months? 5 months. 12 minus 5, 7. So my standard rent is 8,000, which was my answer till now. So 8,000 into 7, 56,000. 9,000 into 7, 63,000. 56, 63, whichever is higher, 63. Meaning thereby, if I proportionately compare, then my actual rent, if I proportionately compare, then my actual rent is higher than my standard rent or fair rent, which I was getting till now, or till my step number 2, it was higher. So this reduction is precisely due to vacancy. Because this reduction is precisely due to vacancy, in that case, my answer is 63, not 96,000. But let us take an example. My monthly rent is 5,000. Now you can say, boss, your fair rental was 1,20,000. You're nothing like municipal rentals. Your standard rent is, let's say, 96,000 rupees. So 1,20,000, 96, whichever is less, his answer is 96. Meaning thereby your monthly rent is 8,000. Now your monthly rent, what you are getting is 5,000. So you are getting less rent, not because of vacancy. You are getting less rent precisely because of some other reasons. And when you are getting for other reasons, we are less concerned on this. Entire 96,000 is going to be your answer. That is what section 23 clause C provides. Now, please note that I am aware that various authors have taken different views on this. This is my view on this. Different authors have taken a different view on this. Some of the authors have taken a view that, okay, from that reasonable rent, take out the vacancy allowance. So let's say the 96,000 rupees, from 96,000 rupees, you take out your vacancy allowance of, let's say, 5 months into 5. So 25,000 rupees, your answer is 71,000 rupees. Compare this 71,000 and 35,000 rupees in my last example. So your 71,000 rupees is the answer. Some of the authors have taken that view as well. Individually, I am not supporting that view. To my mind, it is 96,000 rupees. This section does not talk about reducing any part. This section says what is going to be an annual value. They say that where the property or any part of the property is let and was vacant during the whole or part of the previous year, and owing to such vacancy, the actual rent received or receivable by the owner in respect thereof is less than some referred to in clause A, the amount so received or receivable. That's it. Otherwise, the clause A is going to prevail. And what is clause A? Clause A is fair rental value. They don't say you tamper with clause A. They only say you use the clause A for proportionate rent, nothing more than that. So this is what is going to be your gross annual value. Now from gross annual value, you need to reduce municipal taxes. You might be paying municipal taxes of the last 10 years today. Reduce it now. Municipal taxes have been paid by you to the extent you have actually paid. The amount is the net annual value. So that is what is going to be an annual value. That is how the annual value is required to be computed. This is your annual value for the purpose of your income from house property. From the annual, I mean, if it is a self-occupied house, your annual gross annual value is nil. So if the gross annual value is nil, obviously municipal taxes will not be allowed as deduction. Net annual value is also going to be nil in that particular case. Standard deduction in both the cases is going to be nil because 30% of 0 is going to be 0. From this, now you need to reduce your interest, and that is in your section 24. Now going to section 24. So I believe that the things are getting clear to the students so far. I am now entering into section 24.
Yes, Signage, almost no major queries also.
All right. Right. Now going with section 24. So I have time till 12:30. I have time till 1.
As such, we have scheduled time till 1. And as such, I can see there are no major queries, only 1 or 2 queries. So like we can carry up to 12:30 or so at your convenience, sir.
No, I am open because I have to cover with income from other source as well. So that is the only reason. So I can just.
So so I think so. As per the queries, you can continue presentation like up to 12:45, and from 12:45 we will take for 5-10 minutes doubts.
Okay, so I'll give 10 more minutes for house property, and then I'll switch over to income from other sources.
Yes, sir. Yes, sir. Okay.
Right. So that even that chapter is being the due justice is given to that portion as well.
Correct, sir. Correct.
Okay. Now, deductions in computing income from house property. Income chargeable under the head income from house property shall be computed by making following deductions, namely a sum equal to 30% of the annual value. So 30% standard deduction will be allowed. Now, this subsection, if you refer, nowhere they provide what? Expenditure for repair, expenditure for maintenance, expenditure for a security guard, expenditure for a person I have appointed as an agent for collection of a rent, any manager's expenditure. They nowhere provides those particular deduction. And if you say that, okay, you have all those things, make it a point. That means that you are carrying out this activity in a structured way. When this activity is being carried out in a structured way, you are, heading an inch closer to be covered under section 28. So mark this. So this, why this section is only 30%? They are very clear. 30% deduction ka logic ek hi hai, that you might be incurring certain expenditure and we are lump sum giving you the benefit. But if you say that, no, I have got manager, I have got this gardening, I'm getting the gardening done in the malls, I'm giving the common area services, so those expenditure, I have got to stop. You are carrying out in a structured way, you are a business person. Why are you entering in 22? Go and enter in section 28. Rather, you would be taxed in section 28. It can be taxed as per section 28 only. So first is 30%. Second is when the property has been acquired, constructed, repaired or renewed or reconstructed with borrowed capital, the amount of any interest payable on such capital. Now, the two deductions that they provide. Number A, first is standard deduction and second is interest. For interest, they say that you might have taken when the property is acquired, constructed, repaired, renewed or reconstructed with the borrowed capital, the amount of interest. Now, going with the provisos, the borrowed capital could be for acquisition, construction, repair, renewal or reconstruction. It could be anything that would be allowed. Of course, then they have given certain limits. The first one, provided that in respect of the property referred to in subsection 2 of section 23. 23 subsection 2 refers to what property? The one which was in my occupation throughout the year, which was used in my possession for my residence throughout the year, or which I could not occupy because of my business somewhere else and I used to stay there in a rented house. Those two properties. In case of the property referred to in subsection 2 of section 23, the amount of deduction, or as the case may be, the aggregate of the amount of deduction shall not exceed 30,000 rupees. Meaning thereby, if 23 subsection 2, I am following that for 2 houses, because section 23 subsection 4 says that it is going to be only for 4 says that the benefit is only for 2 houses. So for those 2 houses, the limit is 30,000 rupees. My house cannot, my rent cannot be more than, interest cannot be more than 30,000. Wait, let's go ahead. They say that the ceiling is 30,000, but wait for a minute. Provided further that where the property referred to in first proviso here, meaning thereby the property which is there for my occupancy, my residence throughout the year, or the property which I could not occupy on account of my business or profession or my job somewhere else, and I used to stay there in a rented premises. In that case, where the property referred to in first proviso is acquired or constructed with the capital borrowed, meaning thereby if I have taken a loan for acquisition or construction of the property, and that loan has been taken on or after 1 April 1999, and the acquisition or construction is completed within 5 years from the end of the financial year in which capital was borrowed. If these two conditions are being met, I have borrowed money for the purpose of acquisition or a construction. Mind it is acquisition or a construction. It is not incurring repair, renovation and reconstruction are not covered. It is constructing acquisition or construction. Repair, renovation, reconstruction not covered. And the loan is taken on or after 1/4/1999. So let's say I'm taking a loan today, and the house gets or construction or acquisition gets completed in about 5 years, as the case may be. The aggregate of such amount of deduction under this clause shall not exceed 2 lakhs of rupees. In that case, my deduction will not exceed 2 lakh rupees. Here, this is what we need to appreciate. Meaning thereby, if now see, if you look at clause 2, section 24, clause 2, they say that whatever interest that you are paying would be allowed as deduction. There is no upper limit. There is no upper limit to the deductions that they are referring to. So far as clause 2 is concerned, then they come up with the proviso, रुकिए, limit है, पहला limit, अगर पहला limit 30,000 से ऊपर नहीं मिलेगा, हालांकि वो 30,000 वाला 2 लाख तक चला जाएगा, जो 30,000 का लिमिट है उसे हम बढ़ा के 2 लाख कर रहे हैं, कब? जब आपने कैपिटल बोरो करा हुआ है, you borrowed money for acquisition and construction, for acquisition or construction, repair, renovation, reconstruction, acquisition and construction, on or after 1/4/1999, and that too, the work should be completed within 5 years. Then the limit is 2 lakh. मतलब ये हुआ, अगर मेरा प्रॉपर्टी लेट आउट है या डिम्ड लेट आउट है, then there is no upper limit. Any amount of interest is going to be allowed as deduction. Going ahead. Explanation. When the property has been acquired or constructed with the borrowed capital, the interest, if any, payable on such borrowed capital for the period prior to the previous year in which the property has been acquired or constructed as reduced by that part of the allowed or deduction under any other provisions of this act shall be deducted under this clause in equal installment. It will be done in equal installments for the said previous year and for the each of the immediate succeeding previous years. Now, what do they say? If you look at clause B, they say that interest will be allowed. Proviso 30,000, proviso 2 lakh. अब वो बोल रहे सर आपने जो इंटरेस्ट लिया है, जो पे करा है, अगर वो प्री कंस्ट्रक्शन पीरियड का है, let's say if the construction gets completed today, this 26th of June 2022, then up to 31st March 22 तक का जो भी इंटरेस्ट आपने पे करा है, it would be allowed, it would be a pre-construction interest, and that would be allowed as deduction in next 5 years. Year ending 23, 4, 5, 6, and 7. In 5 equal installments, it will be allowed. So now for 23, my allowability of the interest is going to be the pre-capitalization or pre-construction, the pre-completion, the interest. My house got completed today. On what date? 26th of June 2022. So up to 31st March 22, whatever interest that I would have paid, that, let's say that is 1 lakh of rupees. It would be allowed in 5 installments, 20, 20, 20, 20, 20. And this interest for this year, 23, 24, 22, 23, let's say that turned out to be 190. So 190 plus 20, total is 2,10,000 rupees. Now you are aware, my limit is only 2 lakh rupees. So this total is 2 lakh, I will be getting deduction up to only 2 lakh rupees only. Assuming that I'm falling in 2 lakh category, if I'm falling in 30,000, then anyway, 20 and 190, total is 210. My limit is going to be only 30,000 rupees. They say that, provided also that no deduction shall be made under second proviso unless the assessee furnishes a certificate from the person to whom the interest is payable on capital borrowed, specifying the amount of interest payable by the assessee for the purpose of this acquisition or construction of the property or conversion of the whole or part of the capital borrowed which remain to be repaid as a new loan. What does they talk about? That if I want to claim a deduction, I need to produce a certificate. Not only I can get the deduction with respect to the loan that I have taken for the purpose of construction of the property, but even if I pay that loan and acquire, to pay that loan, I will take another loan, because I might have taken a loan from Bank of India at, let's say, 7%. My Punjab National Bank is giving me 6%. SBI is giving me 5.9%. I go to SBI 5.9%, take a loan, repay the PNB loan. Then whatever amount is now available, whatever interest is now I'm paying to, let's say, SBI, even that would be allowed as deduction. But mark that, penal interest will not be allowed as deduction. Interest on interest, interest on delayed payment of interest, that will not be allowed as deduction. For the purpose of this proviso, new loan shall mean the whole or a part of the loan taken by the assessee subsequent to the capital borrowed for the purpose of repayment of such loan, which I have just covered, provided that aggregate of amount of deduction under first and second proviso shall not exceed 2 lakh rupees. So that's what we have covered, the total deduction of first and second proviso. So in all, I cannot get the benefit of more than 2 lakhs of rupees. So I have taken a loan, let's say, for one, I've got 2 houses limit. One house, I've got a loan for a construction, reconstruction or renovation. The limit is 30,000. Another house, second house, I've got a loan for acquisition where the interest is 1,80,000. Total is 210. My limit will remain 2 lakh only. So pre-construction, post-construction, that also 2 lakh. Proviso 1 and 2 also my limit is going to be 2 lakh only. That is what section 24 talks all about. Now going ahead quickly with section 25. Amounts non-deductible from income from house property. So we talked section 22. When can you enter? 23. How to compute annual value? 24. What deduction you can get? 25. What deductions you cannot get? Notwithstanding anything contained in section 24, interest payable under this act, which is payable outside India, not being interest on a loan issued for public subscription before the first day of April 1938, that is okay. So we can say that notwithstanding anything contained in section 28, any interest chargeable under the act which is payable outside India, on which tax has not been paid or deducted under chapter 17B, and in respect of which there is no person in India who may be treated as an agent under section 163, shall not be deducted in computing in income chargeable under that income from house property. So if you are making a payment on loan abroad to a non-resident, obviously you have to deduct the tax at source. Obviously, the another condition is that there should not be any agent who can be taxed for that particular person. So if the person is available who can be taxed for that particular income, if any agent is available under 163, the things are different. But otherwise, if you are making a payment to a non-resident, tax is required to be deducted. That is what section 25 talks about. Now, going to section 25A. Here they talk about actual rent and unrealized rent. This is somewhere containing an exception to section 22, where I said that the assessee must be the owner of the house. Let's say when I'm getting an unrealized rent, which I was given a deduction in the past somewhere, and now I'm getting that unrealized rent. This unrealized rent or my arrears of rent when I'm getting, even though I am not the owner of the house, but then this is going to be taxable to me, despite the fact that I am not the owner of the house in the year in which I am getting. And I will be entitled to the benefit of standard deduction under subsection 24, subsection 1. This is what section 25A provides. I'm quickly reading it. The amount of arrears of rent received from a tenant, or the unrealized rent realized subsequently from a tenant, as the case may be, the assessee shall be deemed to be the income from house property in respect of the financial year in which such rent is received or realized, and shall be included in the total income of the assessee under that income from house property, whether the assessee is the owner of the property or not in the financial year. So if the unrealized rent which was allowed us, it's just like bad debt recovery we talk about. It's just like section 41 in your PGBP, which says that if your expenditure is allowed as reduction to you, and that liability, that there is a cessation of a liability which was allowed as reduction in the past, and now the cessation or remission of that particular liability is now going to be taxable to you. This is what they talk about entirely, that even though you are not carrying out business profession, similarly, even though you are not owning any house property, but if a case arises where you are not occupying the, you are not owning the house, but then there are some bad debts, so some unrealized rent, now that is received by you, or the arrears of rent which is now coming to you, that is going to be taxable to you as income from house property. A sum equal to 30% of the arrears of the rent or unrealized rent referred to in subsection 1 shall be allowed as deduction. So we'll get the deduction of unrealized rent here. So this is how you need to deal with section 25. Now going ahead with section 26. This talk about property owned by the co-owners. Now appreciate a point that sometimes the property is being owned by a co-owner. Now they say that compute the, so far as the only thing is that if there is a property which is being jointly owned by me and my brother, if a property is co-owned by me and my brother, which has been given on a rent, there is no problem. Compute the value, take the deductions available, whatever net amount comes, add to our respective incomes, matter ends. This is going to be a simple thing. But if the property is vacant or if the property is being used for our own residences, our own occupancies, in that case, compute the NAV, then divide it into two parts because we both are owning it. Then interest will be allowed to both of us up to our limit of 30,000 and 2 lakh, as the case may be. So the interest limit of 30,000 and 2 lakh is a qua assessee. It is not qua property. That is the only thing which is required to be taken care of so far as section 26 is concerned. In the interest of time, I am quickly not referring to it because we need to start with section 27 as well. But then this was the only crux, so that's why I'm just discussing it to that extent. Now, section 27 talk about section 27 says that for the purpose of section 22-26, what is the definition of house property and annual charge? These are given under section 22. These definitions are given here. So they say that an individual who transfers otherwise than for adequate consideration any house property to his or her spouse, then this assessee himself is considered as the owner. If the house is transferred for inadequate consideration, but as a consideration for an agreement to live apart, then in that particular case, the deemed concept will not be applicable. Similarly, a holder of an impartial estate shall be deemed to be the owner. A member of a cooperative society, company, or other association or person to whom a building is allotted because of the membership, that would be considered as your deemed owner. A person who is allowed to take or retain the possession of any building or a part thereof in part performance of a contract referred to in section 53 of the Transfer of Property Act, that would be considered as the deemed owner. And a person who acquires any right, excluding the right by of a lease from a month to month for a period not exceeding 1 year, or is with the respect of any building or part thereof by virtue of any such transaction is referred to in clause F of 269 UA, shall be deemed to be the owner of that building or part. Now, please appreciate and understand, they are from clause 1 to clause 1, 2, 3, 3A and 3B. They talk about the concept of deemed ownership. Now, when can I say that I am deemed to be the owner? I have transferred this house to my wife without any agreement. Without any consideration. Then whatever rental income that comes, that will be taxable to me because I will be deemed to be the owner of my house and my wife will not be the owner of the house. So legally she is the owner, but she's not going to be the owner of that house. If I transfer a house to my son, I would say to my minor son or to my unmarried minor daughter, right? So when an individual transfer otherwise than for adequate consideration any house property or his or her, to his or her spouse, not being a transfer in connection with an agreement to live apart, or to a minor child, not being a minor married daughter. So if I transfer a house to my spouse and there is nothing like separation, if I transfer my house to a spouse because of the separation, that okay, she will because we are getting separated and I'm transferring my house to her, there is no problem. Then deeming provisions will not be applicable. If I transfer my house to my minor married daughter, no problems. But if I transfer my house to my minor son, maybe married or unmarried, or my minor unmarried daughter, without consideration, then in that particular case, the income would be taxable to me only because I will be deemed to be the owner of the house. Similarly, holder of an impartial estate, the estate which cannot be, where the partition is not possible, which is an impartial one, then if I'm holding it, the income is going to be taxed to me. I will be deemed to be the owner of that particular house. A member of a cooperative society, we are aware that if I am a member of a cooperative society, I am being paid, I am being issued a share certificate, I pay a certain amount, I am being issued a share certificate. Because I am a member in that cooperative society, I am allotted one particular house. So a house is allotted to me because of my member. We are aware that so many old houses which are still today in the cooperative societies, where by virtue of the share certificate, those houses are allotted to you. So technically, cooperative housing society is owning that particular house, but you are only a shareholder of the housing society. Here, you are going to be deemed to be the owner of the house. And the next one is that, let's say that if I'm entering into a contract whereby I get a lease and that lease is beyond 12 years, not 1 to 1 month, but it's a lease of beyond 12 years, then still I'll be deemed to be the owner of that particular house. One more is, let's say I enter into a contract. Let's say I enter into a contract with Fenils. Fenils says that, okay, Jignesh, I want to sell my house to you. The agreed amount is, let's say, 2 crore rupees. I'll say, sir, okay, I'll pay you 40 lakhs right now, and the remaining 1 crore 60 lakhs I'll pay you in a year or so. I enter into an agreement to sell with him. That agreement to sell gets registered, and sir allows me to take the possession of that particular house. In that case, though legally the house is in the name of Fenil, sir, but still I will be deemed to be the owner of the house. So this is where you can say the deemed ownership. And the next one is clause 6, which says that taxes levied by local authority in respect of any property shall be deemed to include service taxes levied by local authority in respect of that property. So they talk about what is going to be the taxes. So even service taxes are going to be covered here. Taxes levied by local authority in respect of any property shall deemed to include service taxes levied by the local authority. So that is what the municipal taxes wala definition, that thing is being covered here. So with this, we are virtually done with section, we are done with income from house property. Now we would be entering in the chapter of income from other source. Before I start with this, if you have a query on house property, please raise this query so we can deal that, and then I can have my own time for dealing with income from other source as well. So can we do it that way? All right, I'm starting with income from other sources. Let us deal with income from other source now. Let me remove the let me share my screen. All right, section 56 is there. It is now a charging section so far as income from house property is concerned. Income from other source. Section 56 subsection 1. Now we are aware that charging section for income from other sources is section 56. Now income from other source 56 subsection 1, they say that income of every kind which is not to be excluded from the total income under this act shall be chargeable as income under that income from other source if it is not included to income under any other specified rates in section 14, item A to E. Now please appreciate this section 56 subsection 1. What do they talk about? Understand that section 56 or income from other source cannot be treated as a lost bin section. So everything which is not covered under the other four rates will go to this particular rate. Do not interpret it that way. It would be a wrong interpretation if we take it this way. 56 subsection 1, income of every kind which is not excluded from the total income, which is not to be excluded from the total income under the act. Now, what do they say? Income of every kind which is not to be excluded from the total income, meaning thereby, let us not go with the exempt income. So exempt income are anyway removed. So income of every kind which is not exempted one. So income minus exempted incomes. Income minus exempted income shall be chargeable to income tax under the head income from other source. So income minus exempted income shall be chargeable to tax under the head income from other source if it is not chargeable to income under any other specified head of item any other head specified in section 14 item A to E. Meaning thereby income minus exempt income, if not taxable under other heads, would be covered here. So when I was discussing this, somebody came up with a proposition that it means it is a dustbin section. Jignesh, it covers all incomes which are not covered under the 4 heads. So anything, but then I said, wait, read the subsection 56, subsection 1 again. They say that income minus excluded income, meaning thereby predominantly it has to be an income. If it is not an income per se, how can this be falling here? So if a particular amount cannot be treated as an income, if it is a capital receipt, so capital receipt cannot be an income. What can be brought to tax is only an amount which is referred under section 2 bracket 24, which defines the term income. So unless otherwise a particular item can be referred to as income, you cannot brought this to tax. So it has to be an income per se. Once it has to be an income, it is a capital receipt, section 56 will not come into the play. If it is an income minus excluded income, income, first of all, it has to be an income. Second, it should not be an exempted income. Third, it should not be covered under any other head. Then only it can go to section, to this particular, income from other source. Now, subsection 2, they deal with only those specified incomes which are going to be covered here. They deal with only those specified incomes that are going to be covered exclusively under income from other source only. Now let's deal with those. We can see there are 11 items here. So we have to deal with those 11 items one by one. Of course, since I have been informed that we need to restrict to the items falling under ITR 1, more precisely at the max ITR 1 and 2. So I will not be going into that 5627B. The rest we will be discussing. And if time permits, I'll be discussing 5627B as well, so that we can at least have one topic as a whole completed. But then priority wise, I will be giving with section 56 subsection 2. What do they talk about? The first one, 56 subsection 2 clause 1, dividend. Now, dividend is always going to be taxed on the income from other source. Meaning that, please note that even if dealing in shares and securities is my business. So if I deal in shares and securities and dealing in shares and securities is my business, you are aware that this income is going to be taxed from the profits and gain from the dealing from the security transaction is going to be taxed under the PGBP, because dealing in securities is my business. Despite that being the case, dividend is going to be taxed under income from other source. And that is the precise reason why in this current year ITR, they have categorically made a one change, and they said that now dividend is going to be under IFOS only. So even by any other interpretations as well, dividend is not brought to tax under PGBP. So any dividend is going to be taxed under IFOS only. Now, clause IA says that income referred to in subclause 7, income referred to in clause 7 of subclause 7 of clause 24 of section 2. Clause IB says that income referred to in clause IX of 24 of 2, and IC says that income referred to in clause X of 24 of 2, if such income is not chargeable to income tax under that profits and gains of business and profession. So meaning thereby, here the incomes which are referred in clause 7, 9 and 10, subclause 7, 9 and 10 of clause 24 are going to be covered. Now what are those income? Clause 7, 9 and 10. So let's go to section 222, section 2 definition, 2 bracket 24. Here we are once again covering clause 7, clause 9 and clause 10. Coming here, section 2 which defines income. I'll go to clause 24. where I'm supposed to deal with clause income covered under clause 7. Any profits and gains of any business or insurance carried on by a mutual insurance company or a cooperative society. Now, this is a redundant as of now, so I'm not going into it because right now it is not relevant. Otherwise, it is redundant. Clause 9. Any winning from lotteries, crossword puzzles, racehorse, including horses and card games, and other games of any sort of gambling. So, meaning thereby, this covers your KBC income. Any income that is coming from horse race, card game, that is going to be taxed in the income from other source. Number 10, any amount received by an assessee from his employees as contribution to any provident fund or superannuation fund or any other fund set up under the provisions of Employees State Insurance Act 1948 or any other fund for the welfare of the employee. This deals with a situation where assessee is referring or assessee is receiving any amount, employee's contribution which is being deducted from the employee's salary. They said even if you are PGBP, employee contribution, whenever you are deducting, that would be treated as income. If you are depositing within 15 days or 20 days time, which is given under respective act, then it will be allowed as deduction. If you are not depositing it within that statutory time, then it will not be treated as the income. So meaning thereby, what is going to be covered? A, dividend, the clause 1. Clause IA, not relevant as of now. I'm not going into it. IB, income referred to in clause 9. The clause 9 talk about crossword puzzle, lottery, winning, car, horse races, KBC income, kind of that gambling income, what we are doing, that will be treated here. Please note that whenever I am getting any income of a crossword, lottery, gambling, no expenses will be allowed as deduction. I have purchased 100 lottery tickets. One lottery ticket is of, let's say, 1,000 rupees. And 99 lottery I couldn't get. One lottery I got 1 lakh rupees. One can say that, boss, I earned 1 lakh. I spent 1 lakh. Income is nil. No, sir. 1 lakh is going to be taxed. Deduction 1 lakh will not be allowed. Nothing will be allowed with respect to that lottery. Even if I say that I was coming out with a lottery amount with me, let us say in cash, somebody stole that amount. Even that loss will not be covered. That loss will not be allowed here. Nothing will be allowed. So income referred to in clause, then this clause 10. If I am deducting an amount from the employee, what amount I am deducting from the employee? Their contribution towards ESIC, their share of contribution. If I am depositing by due date, no problems. If I am not depositing by due date, specified in the respective act, then it is going to be added to my total income. Next is interest by way of interest on securities if the income is not chargeable under the head profits and gains of business or profession. Any interest on securities that will be covered. Fair enough. Income from machinery, plant, furniture belonging to the assessee and late on hire if the income is not chargeable to income under the head profits and gains of business or profession. So if I have got some machinery which I give on a hire, if the income is not chargeable under BGBP, it is going to be taxed in the income from other sources. Next one is where an assessee lets on hire machinery, plant, furniture belonging to him and also buildings. Now mark this word, and also buildings. And letting of building is inseparable from letting of the machinery, plant, furniture. The income from such letting, if it is not chargeable under the head profits and gains of business and profession. So now please appreciate, if my let out a building along with the furniture and what is the value for that furniture is not separable, then the entire amount will go to tax either under PGBP or income from other source. Now there will be a serious problem if it is being done so. So normally when a rent agreement is being drafted, normally an advice is given that please, so far as possible, you are letting out an office for, let's say, 30,000 rupees. Specify that 28,000 rupees for building and 2,000 for furniture. So only this 24,000 rupees at the end of the year, that will go to income from other source. Remaining 28,000 into 12 would go, that's 274, would anyway will go to your 276, sorry, will anyway will go to your income from house property. So you can enjoy 30% deduction. Otherwise, entire 30% deduction will be lost. So please note that whenever you are letting out a furnished house property or a furnished accommodation, or a furnished office, make sure that you make some provision, some amount separate for rent while renting a renting, so that you can ensure that your assessing officer during the assessment proceedings do not take you to income from other source and take away your entire 30% deduction. Because normally if I give a house on a rent, normally I don't have any expenditure because rental income will come to my bank account regularly. There will not be any deductions to me. When there will not be any deduction coming to me, when there will not be any deductions, there will not be any deduction. When there will not be any deduction coming to me, I will not have any tax benefit. But if I go to house property, straightway 30% will come to me. If I don't go to house property, other source, no benefit to me. So I want to go to house property. I want to take the house property, but then I don't want to avoid a risk of EO being shifting me to other source. What I would be doing, I will be taking only 20%. I will be allotting some of the value for my furniture. So 30,000 is the 30,000 is the rent amount. I'll say that 2,000 is given to them for machinery or a furniture attached to it. 28,000 for house property. So you can say that 24,000 is the only amount that can be taken to income from other source and not the entire amount. Next is income referred to in clause 11 of 24 of subsection 2. If such income is not chargeable under the head profits and gains of business or profession under the head salaries. Now, what is the amount covered under clause 11? Let's go and check this out quickly. Clause 11 is any sum received under a Keyman insurance policy. So if an amount is received under a Keyman insurance policy, if it is received during the course of the employment by an employee, certainly it is taxable as salary. If it is received by a partnership firm from an insurance company, which is taken on the health of a partner or let's say or by a company on the health of a director or a key employee, that is going to be taxable under section 28. But let's say if an amount is received by a Keyman, which is not falling under salary, which is not falling under PGBP, then it is going to be taxable under the income from other sources. Next one. Now this 5 is a gift. Now this is not applicable. 6 is also not applicable because this is also a gift. The scope gets shifted from time to time. 7th is also not applicable because this gets shifted from time to time. This 5, 6, and 7, the scope, and the 7A. 5, 6, 7, and 7A, the scope is shifted to 10. So I'm not discussing 5, 6, 7, and 7A because this now has been shifted to 10. Now 7B, purposefully I am ignoring right now because it is applicable to a company and our discussion has to be restricted to individual HUF 2, ITR 1 and 2 is applicable per se. So I am 7B for a time being I am skipping. If time permits, I'll be covering at the end. Now coming to clause number 8, income by way of interest received on compensation or enhanced compensation referred to in subsection 1 of section 145B. So section 145, just one sec. Section 145B says that if any compensation or enhanced compensation is received on a compulsory acquisition, in that particular case, it will be taxable in the year in which it is actually received. Section 57 says that 50% of that particular amount will be allowed as deduction. Whatever interest is received, 50% of that interest will be allowed as deduction to that. Now coming to section 9, clause 9, section 56, subsection 2, clause 9. Any sum of money received or as an advance or otherwise in the course of negotiation for transfer of a capital asset, if such sum is forfeited and the negotiation do not result in transfer of such capital asset. Now, originally this was somewhere there in section 51. And people were to use this amount as a tool to carry out a tax plan. Let's say that I want, let's say 20, 30 lakhs of rupees, white money. I don't want to pay tax on it. So I'll approach Fennel sir. Fennel sir, I want 30 lakhs of rupees and I want to pay tax on it. So, and I don't want even that entry to be reversed in a time to come. So Fennel sir would say, with due respect, I'm just giving an example. Jignesh, you enter into an agreement to sell a house with me. Enter into an agreement to sell a house with me. And that house would be sold, let's say, for 5 crore rupees. I will pay you down payment of 30 lakhs. Now, house ka value to 2 crore hi hai. Hum purposefully 5 crore likh rahe hain. So that tomorrow fine morning, if the intention gets changed, still you will not be at a loss. So I'll say, okay, I'm agreeing to sell my house to Fennel sir for 5 crore rupees. Fennel sir would pay me 30 lakhs of rupees. The condition is that Fennel sir has to make this payment clear in 3 months' time. If he's not making me the payment in 3 months' time, in that particular case, what would happen? 30 lakhs will be forfeit. Now, Now, what is the situation till 1415 or 14? Till 1415. If this 30 lakhs I am forfeiting, in that case, nothing will be taxed in the year of forfeiture. It would be taxed when actually I will be selling a property. When actually I am going to sell a property, this 30 lakhs is going to reduce the cost of acquisition. Let's say my cost of acquisition of the house is 50 lakhs of rupees. So when I'm selling after 10 years, 50 lakhs will be reduced to 20 lakhs and indexation will be done of 20 lakhs. The $1 million question is, department has got no track that I had entered into such kind of a transaction. And I have entered into this transaction purposefully to evade the tax, to defeat the tax treatment. So what would happen is, after 13 years, 10 years, when I'm going to sell this house, I'll once again take indexation of 50 lakhs. Department has got no record of it, no taxability. I will enter the 30 lakhs as tax free, which I have taken from Anil sir, which I have forfeited. Now they realize, they say that, boss, if you are taking this 30 lakhs as an advance, if the negotiation fails, if the money is forfeited, in that case, the year in which the money has been forfeited, in that year, the 30 lakh will be taxable. हमें track रखना नहीं है, आपको minus करना नहीं है. जिस साल में forfeiture करा, उसी साल में 30 लाख रुपए पर आप प्रेम से टैक्स भर दो, income from other source पे कोई दिक्कत नहीं है. This is what this provision of 56(2)(10 is. Now 56(2)(9. Now coming to 56(2)(10, which is the most important section in income from other sources. Before I start with this, let me quickly go through all others of 56(2)(10, 56(2). 56(1) says that, fifth section, which is subsection 1, what do they say? They are very clear that if it is an income, if it is a capital receipt, forget it. If it is income, which is not an exempted one, which is not covered by the 5(8), then only you go to income from other source. Then only go to income from other source. Subsection 2 says that nothing doing. यहाँ पर जो 11 इनकम लिखी हुई है, वो तो सारी की सारी इनकम फ्रॉम अदर सोर्स में आएंगी. कौन सी? डिविडेंड. Clause IA not relevant per se, not relevant, not for this session, per se not relevant, so I'm not discussing it because it is not applicable now. IB, income referred to in subclause 9 of 2, income referred to in clause 9 of subclause 9 of section, clause 24 of subsection section 2. What is that income? Any amount that we have recovered from a Keyman insurance, that is going to be covered. Keyman insurance, PF, PSIC contribution recovered from the employee, not depositing, all this particular amount is going to be covered here. Now, if machinery or plant is being let out, income from other source, if it is not PGBP. If machinery or plant along with the building is let out, which is not separable, then it is going to be income from other source, if not PGBP. Then I said 5, 6, and 7 not covered. 7A, scope of 5, 6, 7, and 7A has been transferred to 10. 7B, if time permits, we will discuss. 8, we have dealt with interest on income on compensation or enhanced compensation, we have dealt with. 9, we have dealt with. Now coming to 10. Where any person receives, now mark these words. If you go to subsection 5 here, subclause 5 here, the words are, where any sum of money exceeding 25,000 rupees is received without consideration by individual or HUF. So receipt by individual or HUF. Subclause 5 जब जिस जमाने में था, individual HUF था. Let me tell you, it was somewhere there when I was doing my IPCC, I was doing my P2. It was an amendment brought by that particular time. Probably it was 2004. Yeah, inserted by finance number 2 2004 with effect from 1/4/2005. So it was at the time when I was doing my IPCC. उस वक्त था इंडिविजुअल HUF के लिए टैक्सेबल था. मतलब ट्रस्ट को गिफ्ट मिला, कोई टैक्सेबिलिटी नहीं. पार्टनरशिप फर्म को गिफ्ट मिला, कोई टैक्सेबिलिटी नहीं. किसी और को गिफ्ट मिला, कोई, केवल इंडिविजुअल HUF, और वो भी एनी सम ऑफ मनी, वो 5 में था. धीरे धीरे उसमें लूपहोल्स आते गए, और वो जैसे जैसे लूपहोल्स आते गए, अमेंडमेंट्स आते गए. So that's how ultimately now we have 56(2)(10), where any person receives in any previous year from any person or persons, any person receives, individual, HUF, AOP, BOI, trust, everything is covered. When any person receives in any previous year from any person or persons on or after 1st of 2017, any sum of money without consideration, the aggregate value of which exceeds 50,000 rupees. Meaning thereby, Furniture is giving me 15,000, Alokji is giving me 15,000 rupees, Gupta sir is giving me 20,000 rupees. Total is 50,000. Matter ends. Now let's say the president sir is giving me 1 rupee. entire 50,001 is going to be taxable as income from other source under gift. Clause B, for a consideration, the stamp duty value of such property exceeds such consideration if the amount of such excess is more than higher of the following amounts, namely the amount of 50,000 rupees and the actual sum equal to 10% of the consideration. Matlab kya? If I'm acquiring any immovable property, without consideration, then the stamp duty value. If I'm acquiring an immovable property for a price less than stamp duty value and the difference exceeds 50,000 rupees, then the excess amount that will be going to be taxed here as gift. Of course, they are giving certain exceptions to it where they have said that yes, sir.
Sir, now sorry to interrupt, but now we will need to summarize it because like exactly at 1 the session will automatically end. That's why.
Oh, okay. So let's take the questions then.
Yeah, there are only two questions. I filtered the questions. 2 were like relevant. Rest were like not as such a question. So I shared 2 questions with you in the chat. Like one is like, can we claim house rent allowance if we have house at Ahmedabad but not occupied, but residing on rent at Mumbai?
So we are residing in Mumbai.
Yes.
In a rent. What I understand is that. Yeah. So sorry, sir. Do we have the question in the chat itself? I can read it.
I have written in chat also. Another question is also there, and both the questions are from Bangalore.
Just one second. Can we claim HRA if we have house at Ahmedabad but not occupied, but residing on rent at Mumbai? So if you are residing in a rented house at Mumbai, HRA can certainly be claimed because section 1013A deals with the HRA, and the 1013A does not say that you should not be having a rent, you should not be having your own house. So that condition is not there. So I don't think there should be any problem so far as claiming an HRA benefit. If you are getting HRA, paying a rent in Mumbai, so certainly you can claim that particular benefit. That should not be a problem. Another question is, a person has multiple, this one only, sir?
Yes, the last question.
A person has multiple commercial and residential properties and has given on rent, and that is all the income he has. Should we consider this to be house property income? Okay, so now, once again, it all goes on the facts and circumstances of the case. In this case, what I understand is, see, let me put it in a 2 different ways. Let us say I'm adding some facts to it. Mr. X is a retired person. He has got his corpus of 5-6 crore rupees, which he has got during his working age. Now he has invested. He is getting this rental income. So he is getting this rental income. He is exploiting this property as his investment property only. So this entire property's income is going to be the house property income only because he has planned it for his retirement. He is getting this up. So it is house property. But at the same point of time, this gentleman is having multiple properties. He has borrowed money, constructed the properties, getting a rental income. He has appointed a manager for this. He is providing some other services to them. Then in that case, this case will go to income from this case will go to profits and gains of business profession or income from other sources. Simply because I do not have any other income would not be a ground to treat that income as PGBP income. That can be other reasons as well. So that's where we need to look into that. So accordingly, we can conclude the situation.
Right, sir. So we are done up with the questions also.
Yes, sir. So please advise how can we now.
So like we are done with.
It's only 5 minutes left logically because.
Yeah. So Alokji.
Yeah, I think so. This is a perfect time to offer the formal vote of thanks to our valued speakers today. So once again, a very warm good afternoon to all. At the outset, we are thankful to the torchbearers of this profession, our Honorable President and Vice President, sir. They are at the helm of the affairs for providing all the guiding force in conducting these knowledge sessions for the benefit of our students. And we are also thankful to the Chairman, Student Skills Enrichment Board, CA Sushil Goyalji, and the Vice Chairman, CA Mukla Shedharji, for their valuable guidance and planning in implementing these very important initiatives for the students who are undergoing their articleship. And that's what is an objective of providing some sort of a standardized training to them. Dear students, we are fortunate and honored to have amongst us today CA Kotha Srinivasji as well. He's member of Central Council and Vice Chairman of Committee on International Taxation, for his valuable opening remarks, which has eloquently and aptly covered all the important aspects related to income from house property and other sources, for getting the tone of today's session. So on behalf of the board, we are thankful to you, sir, for being here in the interest of the students. Then we are thankful for our valued speaker for today's session, CA Jignesh Kumar P. Parekhji, for all the valuable information that has been shared with us this present time, sir. The complicated concepts have been simplified for the benefits of our students, and that too backed by various practical examples. We are so much thankful to you, sir, for sharing the practical insights and taking out time for this very important session. We are also privileged to have the presence of CA Fenil Shahji, our co-opted member of the SSCB and session moderator for today's session. We are indeed grateful to you, sir, for your valuable support in putting forward the flow of the session. Thank you for being here with us today in this interesting session. Now, above all, I would like to thank all our students, our audience for today, for being with us this afternoon. I hope you all have enjoyed the learning from this fantastic session of today's. And in case you wish to see the recording, the same is again available on our YouTube channel of CA YouTube channel and also on ICI TV. You can come to our website and you can go through these sessions anytime you want. So prior to winding it up for the day, I would request to all the students to popularize this initiative amongst your fans, peers, and social circles, so that more and more number of students can be benefited from this initiative. So once again, thank you all for being here.